some of the companies that we're working with are raising venture capital, and using our platform is more of like a community engagement and marketing ploy than anything, right? It's like missionally, or like they want their customers to be able to invest, right? And this is the mechanism that allows them to do that.
We kick it off the same way every time. Okay.
Because we're boring as hell. This is another episode of that big talk about small business.
Businesses.
Different every time, my friend.
It is. We like to mix it up. So today we're with Read Ezell. And Read is...
Say it again, that sounded like you said Ezell.
Read Ezell. Okay. Is that not the proper pronunciation? You don't call it
It is actually, but it's easy to drop the E. It's easy to sound a little bit intoxicated saying my name. I think it aligns together.
Read Ezell. Read Ezell.
Yeah.
No, we've got Read Ezell here with us.
Read Ezell.
And I got acquainted with Read first through the WeFunder.com platform.
Uh-huh.
And that's why we wanted to get him on the show today, because that is a what do you call that? A crowdfunding platform? It's not exactly that.
We like to avoid using the word crowdfunding. We call it raising a community round.
Okay.
I think, crowdfunding sounds like something that, it sounds like a Kickstarter. It sounds like something you're doing.
Yeah.
We really like to lean into the idea that we're opening up angel investing to anyone, right? Community round kind of aligns this more with a traditional venture round or other types of equity funders.
So they're with the community round funding platform of WeFunder.com, like I said. I'm just kidding, Reed. But it's really been interesting for me. I knew nothing about WeFunder months ago when I first reached out to them. I was turned on to them by Luke Renier. He's been another guest on our show.
Yeah.
And Luke suggested that with one of the companies that we're both involved with as owners, that we take a look at WeFunder as a way of opening up the equity to a larger group of people, particularly this very loyal customer base that we have.
Yeah.
And, I'm not going to say it's been easy necessarily in every way, but it has been successful, and we have raised a significant amount of equity capital from a completely new group of investors because of WeFunder. So, Reed, tell everybody a little bit first about yourself, and then I want to get into WeFunder, and you can tell us all how it works and how that would be helpful to many small businesses out there.
Yeah, I mean, I'm excited to be here. Obviously, you guys are focused on kind of the practicalities of building, funding, running small business. That's something that one part of that is something I spend a lot of time thinking about. My name's Read Ezell. Like we said at the top, I'm based in Nashville, Tennessee. It's where I was born and raised. WeFunder's based in San Francisco, but I found my way to WeFunder kind of by a circuitous route. When I left home and spent most of my 20s living in other countries, I was a consultant. I was a teacher. I thought for a while I was going to be an academic. Once I got into that, realized that was really not what I wanted to do. Not in the financial services industry at all. Most of my 20s were spent in Egypt, Saudi Arabia, and Qatar. When I came back, what I've always been interested though is kind of interested in these kind of big problems, creating, kind of opening up more access. Right. When I first went to the Middle East, it was about helping people understand more about that part of the world. As I got older, I realized that I could have more impact back home. That's what brought me back to Nashville. And I really fell into working at WeFunder kind of accidentally. I founded a nonprofit when I moved back home to the country, back to Tennessee, piloting a social impact experiment, piloting a guaranteed basic income in a specific neighborhood in Nashville, which is back kind of 6 or 7 years ago now. And I met the president of WeFunder, who lives in Nashville as well, through that. My experience fundraising for that initiatives and my experience trying to figure out how to do this thing without much precedent was kind of what led into me working at WeFunder. There was also realization that I didn't want to stay in the nonprofit space. But really at WeFunder, what I do now is I help founders raise capital. I help them understand what is a new way to raise money, different than traditional bank debt or, venture funding. I think WeFunder kind of can slide up and down the scale closer to either one of those, but generally fits in the middle. And engaging communities of folks to be investors in their business. We talk about letting your fans and community invest in your company. And I think can be a really powerful mechanism.
Hey, Reed, going back to the very first comment you made when Mark incorrectly called you a crowdfunding platform, which I apologize about that. Like, obviously everybody knows that.
No, I mean, he's not the first. Mispronounced my name.
Yeah, right. Mispronounce your name. Got what you guys do completely wrong. I mean,
it is what we do, right? Fundamentally, what we're doing is letting so to take it even a step back from crowdfunding and what WeFunder does today, right? WeFunder was started by a couple of folks who were young entrepreneurs, and they felt it was silly that they couldn't invest in their friends' businesses, right? They're not rich people. They're people that are working alongside founders every day, and they wanted to be able to write $1,000, a $5,000, a small check into their friends' businesses to support them. It turned out that was illegal. In traditional the SEC regulations, I think it was 1933 until 2016. It was illegal for someone who was unaccredited, meaning they have a net worth of under $1 million or an income of under $250,000 to invest in a private company. The founders of WeFunder WeFunder actually started as a petition to ask Congress to include in law the ability for regular folks to invest in private businesses. And that's how WeFunder started.
What year was that?
The law was called the Jobs Act. It was passed I think it was, developed in 2012, passed in 2013. WeFunder went through Y Combinator in San Francisco in 2013, and then took the SEC about 3.5 years to put rules around this. So Regulation Crowdfunding, which is what the regulators call this, has been legal since 2016. And what it allows is anyone to invest small amounts in a company. Now, there's been a little bit of a circuitous route since then. I would say the way that the regulations worked initially wasn't all that great. They're iterating on this. But WeFunder basically started as on the belief that it's un-American, that you can't, you can go to Las Vegas and gamble your money. Why can't you invest in a risky startup?
So, and I guess the way that it all works is like it ends up. I mean, are all the people that are investing, are they kind of fall underneath a single? Is there like a single entity that are basically?
Today, yes. So in the way that it was original, when I say that the regulations didn't work all that well at first, today, if you're investing on the WeFunder platform, in 99 out of 100 cases, you're investing into an entity called a special purpose vehicle, which in startup investing is a very established term, but most people don't know what that means. Basically just means that you're actually not investing directly in a company. You're investing in an LLC that is then pooling the capital of a lot of people and investing directly in the company. And so what that means for the company is that rather than adding 1,000 investors to their cap table, they're adding one. There are 1,000 people represented in their cap table by that LLC, which is very important for companies that want to raise multiple rounds of capital. Having 1,000 people on your cap table, if you're a really early stage company, and you want to raise, for instance, venture capital, is going to be a very big red flag. But yeah, so it's a single line of your cap table. Anybody can invest. And the ways that works, it's pretty various, right? Some of the companies that we're working with are raising, like I said, raising venture capital. And using our platform is more of like a community engagement and marketing ploy than anything, right? It's like missionally, or like they want their customers to be able to invest, right? And this is the mechanism that allows them to do that. One of my favorite raises of all time, though, is a wine bar that's about 4 blocks from my house in Nashville called Bad Idea. The guy who started it was he was a sommelier in fine dining restaurants in Nashville for a decade. Coming out of the pandemic, he wanted to, run his own place. And he said, what he said is he'd spent a decade convincing, telling people that starting a wine bar in Nashville was a bad idea. That's where the name came from. But I pitched him on, rather than going to a restaurant group and sharing 50% ownership with a restaurant group that would then want to have a pretty significant say in terms of how he ran his business, and maybe even push it away from, being a wine focused restaurant to something that traditionally works better in our market to being, a more, food focused restaurant where the margins are a little bit better, or where there's a more of a margins aren't better, but there's a more proven model. He decided to raise on WeFunder. He raised $750,000 on WeFunder. He had a couple of backers lined up before, but he raised that capital from, I think, around 150 people. Some of those were people in the neighborhood. Some of them were a lot of them were people that had known him from coming into restaurants that he'd worked in over the years. Some of them were, fellow restaurant, hospitality workers that just wanted to support him, right? And people supported him at, $100,000 and $100. Sorry for I don't know what just popped onto my camera.
Yeah, what?
That's not a venture capital raise. It was about engaging people that wanted to see this thing happen and that believed in him. And ultimately, that's what I think early stage capital is about. Even if you're talking to a venture investor, right? They're investing in the team. Who knows the team better if you don't know a venture capitalist than the people that know you personally?
Yeah, I think the Janus capital raise, or Paragon Motorcycles Inc., reflects that too. I mean, we just have people who they like our product, or they have dealt with the company as a customer in some way, and they like the company, and it's not necessarily a purely rational decision like a typical, private equity or venture capital investor would make, where it's like, okay, well, I need to get a 10x return in the next 3 year, it's much more emotional than it is necessarily logical.
First of all, I would argue that a lot of venture capital investments are more emotional than venture capitalists would like to admit, right? Like, people,
I wouldn't.
There's a lot of gut in that industry as well, right?
Sure.
And there's a reason why venture capital tends to, is really weighted toward people that look like venture capitalists, meaning, white male founders that went to really great colleges, right? It's like, that's because of just everyone believes in the people that look like them because they know that they did a thing, right? I think that's a kind of a very understandable bias of that industry. Not that it's good, or I think that you could probably argue that it's a very bad thing, that kind of inequality in distribution of capital. But yeah, on WeFunder, you're tapping into a different kind of approach to investing. Doesn't mean that you're not going to see a return, but a venture capitalist has to invest in a company that they're investing in the companies that they think have the most likelihood to return their fund, right? That the logic of venture capital is that every company that I invest in needs to have the potential to 1,000x, right? There are a lot of businesses out there that have the potential to 10x. And if I'm not a venture capitalist, I don't need to I can invest in those businesses. And so it kind of opens up the logic a little bit, right? Invest in passion because maybe you're just investing because you like the person, but also maybe because you're closer to, in Paragon's case, right? Like, the motorcycle industry, you see the potential of small displacement motorcycles, venture capitalists aren't going to invest in that because it's definitionally a niche market. But like, if you've seen that grow and you believe in this company, go ahead and invest. And we think that there's a lot of knowledge and a lot of like potential returns in investments like that.
So tell us a bit more, Read, on the mechanics here. Like, I guess, first of all, does it matter what stage a company is to get involved, to engage with WeFunder?
No. Now it matters what stage a company is to how much money they could raise, right? And I think that's one of the biggest pitfalls that we see is, people come to us and they're like, hey, we want, the most you can raise under the regulation that we traditionally work under is called, Regulation Crowdfunding, is $5 million. Now, to do that, you need audited financials. There's some friction there to be able to do that. But most of the companies that I talk to shouldn't set out to raise $5 million. What they should set out to do is engage a community, and they should set out to raise the capital that community can support. And then they should use the WeFunder platform to expand that community, right? What the power of regulation crowdfunding does is allow you to accept anybody as an investor, and then you to publicly solicit for investment, which you can't do at a traditional fundraise.
Okay.
That public solicitation is in some ways helped by WeFunder, but it could also be, to email, getting your friends to email their friends.
Yeah.
Or,
Sure.
Getting on a podcast and talking about the fact that you're raising capital, right? You can kind of expand your surface area of investors that way. And so I think one of the biggest mistakes the companies make is they think, okay, I need X amount of dollars in the next 2 years. That's what I want to raise on WeFunder today. Really what you should be thinking about is, okay, I've got X amount, I've got a community of this size today. And I think that I can reasonably expand that community through this process from X to 2X or 3X, and estimate the amount of money that could represent. And the most effective companies that we see do this are doing it repeatedly, right? Like, you build a community over time that stays engaged and sees your growth and follows your story. And that's where this becomes very powerful, right? It's not, I'm going to raise $2 million in the next 2 months from a bunch of $100 investors. It's, I'm going to raise, maybe it's $200,000, maybe it's $500,000, maybe it's $1 million, that I'm going to then continue to engage them and kind of bring them into the process of building the company. And then it's not just about money. It's about, community engagement. It's about having a built-in street marketing team of people that are going to go out and try to help you make connections. And if you hit some milestones, those same investors are likely to invest again, because on paper, you've increased the value of their investment.
That's the key right there. It's performing, and then you make believers out of them, and then they become.
So you can do another round?
Yeah.
How many rounds can you do?
You can do it every year.
So once a year, basically. You can do one time per year?
You could launch multiple raises in a year. The caps in terms of how much capital you can raise are set in a 12-month time span.
Okay.
So they kind of, that number resets.
So explain that.
If you're raising yeah. So the way the regulations are set up for regulation crowdfunding, right?
Mm-hmm.
There are 3 kind of tiers of a Reg CF raise. And so, and there's a different set of financial disclosures that are necessary for those 3 different levels. You can raise up to $124,000. Basically, the biggest downside of Reg CF, or friction point around Reg CF, is you are publicly disclosing your financial statements. But under 124K, they are just self-compiled. Up to 1.24 million, you have to get a CPA to review them and say, basically, yeah, this makes sense. And then above 1.24 million, you have to get those financials audited, up to 5 million. And so raising repeatedly does create, you have to basically build into your business that you're going to keep your books clean and get a review or an audit every year. The first time people do that, it tends to be very painful, but then if you keep things in order from there, it becomes less painful. But yeah, I mean, you could raise repeatedly. the way that we think this should be done is kind of, it's not about Reg CF. It's not about the regulation. It's about the philosophy of capital. This is a different way of a different source of capital. Like I said, bank debt, venture capital, traditional angel investors, all those are people that you might go to. Your community is just another among those, and we should be stacking that alongside all those different sources of capital. But yeah, the value though is the public promotion of this, right? So I'm biased, but I think a way that a company should do this is, if you're going to raise money, set up an account on WeFunder, start building a community, start communicating with them, run a fundraise, continue to communicate with them, update them, and then maybe in 12 months you do another fundraise, right? It's not, you're building this kind of muscle of communicating with your community into the operation of your business. And what it does is create options for you, right? If you are a company that's on the venture ladder, and you haven't hit the milestones and, at the end of 2026 that you wanted to, your customers are probably like, if they like what you're doing, are going to be ready to invest to help you get to those milestones so that you're ready for your next venture raise. There are a lot of companies out there that aren't on that venture ladder, right? Rather than taking on debt, what this is basically friendly capital from in Paragon's case, motorcycle owners, in Bad Ideas case, wine enthusiasts, right? That are trading access, and they want to be in the process, but they're willing to help you grow the business.
Yeah. It's like somebody should look at this as like, I went public and I'm doing shareholder meetings. I'm taking care of it. You don't want your shareholders to start selling stock.
Yeah, I think the thing,
right?
Communication. Yeah, it's a good discipline probably to have just in your business in general. You're not commingling your personal stuff with it, because that would be wrong. You've got to have good accounting, right? And you've got to have good information sharing with your owners. Those are all sort of good disciplines.
Hey, Reed, can you hear Mark chomping on his chewing gum when you're talking? Because I'm sure. Okay, our audience. Sorry about that, audience. That Mark is continually smack in the microphone. But I'll get back to the business part of this.
I got the gum from you.
I just didn't know you were going to be like putting your face against the mic and like smacking.
Sorry. Here, should I do it again?
Yeah.
I can hear it now.
It's disgusting, isn't it?
Oh, Lord.
Anyway,
I wasn't chewing with my lips open.
You know what I do like, Reed, about one thing you were talking about. So I get extremely irritated. I'm like a really bad capital raiser because I get so irritated. You made a really good comment that I want to point out to the audience. My irritation comes whenever I'm sitting here. I got this company, take podcast videos, for example. We know podcasting is growing like crazy. It's actually outperforming radio now. There's more listeners on podcasts than our radio for the first time ever. Mm-hmm. So it's overcome a major media outlet, but that's just the podcast part. Then you got video. YouTube's the biggest media company under the sun, and it's all video. Mm-hmm. All social media is using video. And then I go to, and so we do both, right?
Yep.
At our company called Podcast Videos.
Your firm does again, Eric?
Podcasts and videos.
That sounds like a good name to me. I don't know.
Right. Yeah. I mean, like obvious, but you go to investors and they're like, man, I don't know. I don't know. And you have to explain to them 17 hours worth of explanation. They want to see a bunch of stupid data points and they still leave. And like you mentioned before, it's like, how freaking obvious is this business that we're in that you can't even get past the thought, but you're pouring money in some of the dumbest things I've ever seen in my entire life.
But show them, don't tell them.
Right, exactly.
Right. You should like the biggest mistake that I think, I've never raised equity capital. I've helped a lot of people doing it. So like, I don't claim to be an expert here. Like I said, I ended up in this kind of by accident. I love my job and I love helping founders raise capital. But the mistake that a lot of first-time early founders make is like, they're heads down in the business, and then they decide they need to raise money, and that's when they start trying to talk to investors, right? What you should have been doing is telling investors about all the things you're doing heads down in the business for the past 6 to 12 months, because then you don't need to spend 17 hours, right? You've gotten buy-in. And not every investor is your investor. And the ones that are your investor will stop following your updates, right? And so the people that are there are the ones that are there for you.
Well, the big point I was going to make though was, as you mentioned, motorcycle enthusiasts investing in motorcycles, wine enthusiasts investing in the wine business, people that like podcasting, investing in podcast videos, people that are social media video creators investing in a company because they understand the goddamn market. And I don't need a bunch of freaking other types of objective, leverage going on. I'm a wine enthusiast. I really appreciate wine. I can see why people would come to this place.
Sure.
You're a great business. You seem like a good person.
Yeah.
You've done this before. Here's $250. Here's $5,000, whatever. That's that community thing that you're talking about. That's when you said that kind of gave me a little bit of a breath of fresh air, that there's a different way for a founder to capitalize their business with a community, like you're saying, that can support them.
Yeah. And the other thing is that they, like Reed said, I think early on, is they're not necessarily going to try to control your business and take you off the rails, which we all know. I mean, I call it the golden rule. He or she has the gold rules.
Yeah.
And of course, you and I both talked about that. So many founders, they're stuck in this ridiculous model of I come up with an idea and then I go out and raise and I do my business plan and then I go raise outside equity capital to investors who immediately now control my business. So I wanted to be self-employed. Now I'm not self-employed.
Yeah. Okay. Yeah. You're in a very risky employment. You basically quadrupled your risk and you're still employed.
I think the other thing too is it makes it easy for somebody like yourself. Let's just say, as an example, if you wanted to take podcast videos onto WeFunder, it gives them a chance to know a little bit about you, and your success as a business builder and entrepreneur and exit, and successful exit guy, without having to do that yourself in a real, you're kind of self-conscious. Like you wouldn't go to somebody and brag and go, hey, I've done it. But if they see the story right there, they can read that and they know a little bit about you now. And I think it's going to build more trust.
Yeah.
I agree. That
I totally agree. I think it's like, it's a really big miss, but it's also, it doesn't have to be either or, right? Like we see companies raise a WeFunder, and it becomes the proof point to the bigger investors, right? It's like,
I can see that.
A story that we've told for a long time. This is before my time at WeFunder, but it was a company called, I started to tell the story and now I'm forgetting the name of the company. They were working on a solution for just to solve, cure cancer in dogs, right? They went through, they're trying to raise venture money, but this is like a big problem. And they were talking to investors, and the investors were like, "Hey, you don't really see the market here. Like, who's going to spend $10,000 on a treatment for their dog?" They came to WeFunder and they raised, exactly. People that like love their dogs will do that. They raised like $300,000 in 2017 on WeFunder, and then they took that, like the like customer validation of investors in like being passionate about this problem, and went and raised, a seed round and have grown the business. There was an update recently, they've like just made they just passed one of the trial milestones, right there. They've been able to continue to build this business. And it started by being able to engage the community, right? Like, another founder that I met through WeFunder, it's a company called Adam Limbs, right? They had like a DARPA grant to build kind of AI prosthetic limbs, right? So like targeting veterans. That takes a long time to build that company. But what the founder of Adam Limbs said is like, go lean into your weird, right? You don't need to be everything to everyone. Go find the people that like love and resonate emotionally with what you're doing, and turn them into your investors, turn them into your community. If you can start there, you can expand, right? But like, just go find the people that believe in what you're doing, right? Whether it's because of you, Eric, or Mark, and what you're doing and your track record, or just because you're solving a problem that there is, 0.5% of the world relates to that problem on like a fundamental, visceral level, right? Those are the people that are in your community.
So once the money's raised and it's all under that SPV, special purpose vehicle, that's in an LLC. Does it have like who is the representation for that LLC?
Tradition. So it's interesting. WeFunder is actually undergoing a pretty big evolution right now. Really, actually, Mark, I met you through the Paragon or Janus/Paragon Motorcycles raise. Since that raise, we now support Reg D, meaning traditional angel investment as well. And with that change, we made a big change in terms of our structure. In the past, we required companies to have a lead investor in their Reg CF raise, and frankly, made selling the platform harder. But we basically said, okay, if you're going to raise from retail investors, you need to have at least one person with some significant skin in the game that's investing on the same terms. That's going to offer those people representation on the platform. Today, that's no longer required. The founders can be the proxy signer for the SPV on WeFunder. The reason we're doing that is because it aligns with Reg D fundraising and how people operate there. Now, we still really believe in having a lead investor, and if a company is trying to raise on, what I view as what we see as, out of touch terms, we'll probably still say, hey, like, we're going to host this raise, you need to bring in somebody writing a significant check on these terms just to like prove that there are real people out there that want to invest on these terms.
Yeah.
But from a control perspective, Eric, the founder can be the signer, the proxy signer for that SPV now.
Sounds like a great deal for a founder. I mean, you like that has no, so it's not voting stock, obviously.
We don't common stock raises on WeFunder, so it is the founders, the investors are investing in preferred shares that have preference over common, but they're not delegating rights to somebody that might work against them. Does that make sense?
Yeah, so it's non-voting preferred stock.
Yeah, most people don't realize that really preferred stock, in my opinion, is not preferred. But anyway,
Why?
I always get into arguments because it doesn't have voting rights. Okay.
But it has like preferential for like sales or whatever, right?
Yeah, but most of the time it functions like debt more than it does equity. But anyway, we could have that discussion.
We do that because we think that like most angel investors are investing on preferred. And so we think that our micro angel investors on WeFunder deserve the same right. I think you're right, Mark, that in most cases it's like not actually going to end up being that much of an issue. And you're right, if there was like a liquidation of assets, the preferred investors are just getting, that first, and it does kind of function like that. But really what we're trying to avoid is a venture investor or some big investor coming in later and getting preference over the retail investors just because they were small check investors.
But let's go back to the legal form of the entity that is raising capital on WeFunder. So let's, I know in our case, we were a C-corp, which makes it very easy because other entities can own ownership in a C-corp. But if you had an S-corp, it's not going to work. Is that not right?
Yeah, you cannot raise via Reg CF as an S-corp.
But you can as an LLC, though. Is that right?
Yeah.
You don't have to be a C-corp.
There are some complications as an LLC, right? As an LLC, because an SPV is an LLC, because the entity that people are investing is an LLC, an LLC raising on WeFunder doesn't offer the same simplification of the cap table that
I've never been
a C-corp does. So you'd have to issue K1s every year to all of the investors, which if you have a very successful raise becomes a pretty big job. It's our strong recommendation to anyone trying to raise more than like the 124K level is you should either convert to a C-corp or choose. You can stay in an LLC and be taxed as a corporation, right? You just make a tax selection. But if you're raising equity, you really should do that just because it creates a lot of room for error.
I'm a big fan of C-corps anyway today. I mean, first off, the tax rates are lower than individual tax rates. That's a big plus. And if you do want to preserve, if you want to retain earnings and you're not trying to pay out a bunch of profits along the way, you're trying to grow your business, C-corp's just a better structure. It's easier to retain. Because the money that an S-corp or LLC makes is a pass-through entity. Whether you take it out or not, it's taxed
because the company
individual level.
Because the company made the profit.
Yeah, if the company makes $100,000, let's say, and you're the sole owner of your LLC, you get the K1 that says I made $100,000. You might not have gotten any of that
because you've been putting it back in the business.
You've been putting it back in the business. So the way the IRS views that is, you made $100,000 and you reinvested. You pay tax on the $100,000.
Gotcha.
With a C-corp, you only pay corporate tax based on what you made, and the corporate tax rates are lower. Like your individual tax rate or mine is going to be higher than the corporate tax rate by far today. It's, what is it, like 21% or something? It's low. It's in the 20s. It's in the 20s. It's very low now compared to your individual tax rate. And so that's the reason. It's just easier to retain earnings. Plus, it's sort of the most legitimate legal form of organization that gives you the most flexibility.
Is a C-corp like the oldest? The OG?
They're all corp start out as a C-corp, and then you can file an election to be taxed as a subchapter S. They all start as a C-corp.
Even LLC?
No, LLC is a limited liability company. That's a totally different entity.
Well, but I mean, like, what's the original corporate structure?
Corporation would be a C-corp.
C-corp.
Mm-hmm.
I'm just thinking like back in the day.
Yeah.
When all this stuff really, because we had that one episode, this is kind of cool, Reed. We were talking about, I was doing my history stuff, but one of the big reasons that the writers of this book, American Entrepreneur, gave for America being so successful and being our strength that we are is because of our legal laws that we have related to corporations and how individuals can set up entities and are protected.
It's out-survived them.
That have out-survived them and all that.
Right.
Versus Europe, versus Asia. Like, it's the way the American legal system is set up has allowed us to be the country that we are. And I just wonder if it was C-corp, was the OG.
Yeah, that's the original.
You think so?
Yeah. Oh, I know so.
Oh, you know that as a fact.
Well, I know that C-corp is the highest level in the basic corporation.
But that doesn't mean it was the original, though. I mean, like, I'm going to do some fact checking and bust you out on LinkedIn.
I don't know I don't know anything about this. You got me Googling in the background here to see if I can sound smarter than you guys.
They didn't necessarily call it a C-corp, but it was a corporation.
Okay, that's fair.
Yeah.
Okay.
But I mean, I despise LLCs for a million reasons. I mean, how do you deal with the idea that all members of the LLC operating agreement have to sign off on any changes to it when you've got a WeFunder as part of your cap table?
We're still putting them into a pool, right? And so there's still a single proxy for them. The real issue is around K1s and taxes, right? It's like we actually charge an extra fee if you raise as an LLC because we'll do the K1s for you, but it's a lot of work every year. And if you choose not to pay that fee, then you're going to have to do it yourself. And if you raised, the average investment on WeFunder, the median investment is something like $250. The average investment's a little bit over $1,000. But if you raise $2 million, it's a whole lot of K1s.
It's a lot of K1s, dude.
Yeah.
And how does I mean, if you were a LLC and you paid distributions out to your owners, typically you try to do that at least to cover your tax obligations. In my experience with any pass-through entity, I always tried to pay out 40% at least to cover taxes.
Yeah.
How do you deal with these WeFunder investors? They're not going to get those distributions, or are they? I mean, in a normal
anything that you basically would treat the WeFunder investors as a single entity, and then we split it up for you. So you would send a single check to WeFunder.
Checks.
Oh my God!
And then WeFunder cuts it up.
No reason y'all charge an extra fee.
No kidding.
My gosh,
Yeah.
can you? That's brutal.
I mean, we also do you can do a revenue share
pass-through.
on WeFunder, right?
Yes,
we do that as well. I think
I'm
that's
sorry,
actually
Reed, I was
pretty cool.
talking. What?
I apologize. I'm talking over
No,
you.
what were you saying?
But you can do a revenue share on WeFunder, right? Like, so we do that as well, right? So you're saying you're marking a percentage of revenue quarterly, annually, or whatever the time scale is, and you're sending it back to WeFunder, and then we're chopping it up into, however many pieces, according to the size of the investment.
That's interesting.
But yeah.
So that's a value for somebody to invest, right? Like they're kind of participating when
for a brick and mortar business or something, right? Like we that's not our core product, right? Like our product is built around C-corps raising equity or future equity, right? The most common instrument on WeFunder is a SAFE, followed by preferred equity, followed by a convertible note. But there are businesses out there where a revenue share makes sense. If you got healthy margins and you're not trying to like scale to be a huge business, but you just want to, maybe you need to raise a little bit of money to build out a storefront. So rather than taking on debt, or rather than having new ownership, you just build your business model so that 4-5% of your revenue is going to go toward paying back these investors, some multiple on what they invested, 1.5x or 2x or something.
Ready to level up your show? At podcastvideos.com, we offer industry-leading recording and expert marketing to help your show reach more listeners. From creation to distribution, we've got you covered. Visit podcastvideos.com and elevate your podcast today.
You mentioned something that kind of goes to my next question. I want to make sure I get this in. I'm sorry I'm kind of hijacking this entire podcast.
You're not. I mean, when you got hair that looks like yours, as good as that is,
that's what I'm talking about.
You can take the whole thing. Man.
Thanks, bro.
It's all yours.
I appreciate that. So you said safe. Let's talk about valuation. So if I want to go on a raise, like you can do a safe. So I don't really necessarily have to say what a valuation is. People are just investing in like it's a safe.
Raising on uncapped safe on WeFunder, I would really advise against, particularly in this market, right? Like you're just not seeing many uncapped safes. You were back in 2021 when people were investing in everything, without reservation. But the most common instrument is a safe. Most retail investors, frankly, look at the valuation cap on the safe and think, that's that's the bottom part of the fraction. And when they're kind of thinking about their investment, which is not strictly accurate. But yeah, you can raise on future equity. The reason I think an uncapped safe doesn't work is it creates hesitancy among your community. And on WeFunder, you should think of the WeFunder investors. There's 1 million investors on WeFunder, right? They're a force multiplier, and their force multiplication is going to be based totally on you kind of eliminating all of the questions that might be top of mind that might give them pause, right? And an uncapped safe, particularly when you're in a marketplace raising an uncapped safe next to a bunch of capped safes, why would I invest in that much less certain outcome?
Once you start talking about safes in general, I think it implies a sophistication level of an investor that a $250 or $1,000 investor probably doesn't have. Too. I mean, think about that. They understand having fractional ownership in this thing.
Yeah.
I think
there are real questions around that.
And
I think that's, investor education is a big piece of what we think about all day long. But the place I would push back there, Mark, is also, I think equity is obviously the most understandable structure. But the biggest upside, any deal on WeFund, the biggest upside deals on WeFunder are all on safes, right? So the people that are coming to WeFunder, like really looking for interesting, like an economic upside, are interested in those deals, and they're educating themselves. And I think WeFunder as a platform, we should probably do more work helping to inform people.
You should have your own video podcast.
Yeah.
You should have a video podcast.
I know a source for that.
Let's talk about it offline.
Yeah, I mean, they do everything here. This is unbelievable.
I want to close this deal right now, man. Right now. But so explain to our audience about cap safe real quick. I mean, since you guys do educate, like.
Yeah. So the SAFE, first of all, stands for Simple Agreement for Future Equity. It's been popularized over the last decade or so. It came out of Silicon Valley as just kind of a simple way for companies to raise early capital. Basically, what a SAFE is doing is putting off the issuance of shares in stock and that work and saying, hey, like my company's too early to make any promise, any like hard promise about the value. But what a SAFE is saying is I'm basically giving you an IOU for future shares when I issue them in exchange for your capital right now. When I talk about a valuation cap, it's saying basically the implicit promise is when I issue shares, it's very likely that the value of my business is going to be well above this cap, but your equity is going to be issued at or below that cap. And so if you raise $1 million the easiest way to think, there's pre and post money safes, but the most straightforward way to think about it is a post money safe. So if you raised $1 million on a post money safe, meaning after the $1 million is in the business, it's valued at $10 million. When that safe converts on a future financing that's on a $100 million valuation, maybe it's priced at that point, those investors in that $1 million safe will have 10% of the business because they will convert to equity at that $10 million cap.
Yeah, or the business is sold.
At that point, so your $10 million, your $1 million investment is now worth $10 million if the $10 million cap raises price at 100. It's a little bit esoteric, but I think as long as you're talking about post money safes, it's pretty straightforward. The working it out is easier. You have to factor in dilution and all these things. But the reason safes are used these are companies that are going to move very quickly and raise a lot of capital before they're kind of establishing a baseline for their business, right? Like, it's not if I've got 10 customers in a market of 1 million customers, my revenue today is not an accurate representation of what the value my business model can create.
Yeah,
makes sense.
And then you also do convertible note. Did you say that earlier?
Yeah. Which is similar. It's an older instrument that has an element of debt involved, right? It's like if the company fails and doesn't raise additional capital, instead of going poof, the investors there's a debt element where they could be paid back with interest.
Yeah, I guess I understand convertible note. I'm just trying to think about it in a WeFunder scenario. It gets a little confusing on how all those, but it's just all the same principle because it ends up being just one investor basically that has a convertible note. It's just
fractionalized, right? It's just smaller shares, right? So, you raise $1 million and I've got $100 in it.
Let me ask one more question though. I think it's important. Let's say I'm an investor in WeFunder and I buy $1,000 worth of ownership in whatever it is. How can I ever get that money back if that company is not sold externally? Is there any liquidity to it at all, ever?
That's a great question, because I think it's the biggest problem facing our industry, liquidity. There is not a formalized secondary market for private investments anywhere, right? I mean, we facilitate secondary transactions pretty regularly for individual investors. They find somebody that they're going to sell their shares to, but the reality is that there's not good liquidity. And if you're selling an investment in a company on WeFunder to somebody else, you're probably selling it at a huge discount, right? The expectation of an investment like this should be, I'm either going to, either there's some sort of, dividend, like a revenue share or a profit share coming back to me, or I'm probably never going to see this again. Which is why, this is why the venture model kind of is built on making a lot of high risk bets, and they're looking for big returns to each of those bets. But we've seen liquidity, like we saw the first company to raise a WeFunder did an IPO 6 months ago. It's called Beta Bionics. It's a biotech company. We're starting to see that. These are real issues that the SEC has to deal with, right? In helping companies go public more easily. Back in the 90s, people went public with a $50 million valuation. Now, Stripe is worth billions and has no plans to go public. Liquidity is a question. The reason I work in the space is because I think that problem will be solved. But it is an issue there's not a straightforward solution for right now.
Sure.
So about out of time, what I wanted to make sure we do, right? We've been talking like, okay, our listeners, your small business, you need to raise capital. We've talked about a lot of complicated scenarios, honestly. Right?
Sure.
But I think that give you the last couple minutes here, Reed, because what WeFunder's value that you're providing for these founders is to simplify this process, right? And to help guide in, like, you know what I'm saying? Like, I think I want to make sure that the listeners understand that value after this complicated.
I appreciate you saying that, Eric, because I kind of wanted to get there earlier too. And I get lost in my own thoughts. Like the way that if I'm a founder raising states, WeFunder's changing as a platform. Traditionally, we've only supported Reg CF. Like I said, Mark, we now support Reg D fundraising as well. And so the reason we've done that is we really disliked this kind of, there was a kind of a split in fundraising. People were like, I'm raising via Reg D or I'm raising via Reg CF. It shouldn't matter what regulation you're raising under, right? It should matter who, like the capital that you're raising is the important thing. There are different benefits to different capital, right? Raising from venture capital, their promise is a Rolodex and connections and stuff. Your community is promising loyalty and a street team and friendly, kind of friendly money, basically. If I'm a founder approaching this today, what I would be doing is setting up a page on WeFunder and starting to build my community there. And likely I'm starting my fundraise, closing a few bigger checks via Reg D, via like bigger angel checks, which means that only accredited investors can invest to kind of price out my deal. And then only when I'm done with that, I transition to Reg CF. And what Reg CF is offering is the ability for you and your supporters to help promote that you're raising capital and empowering you to reach a bigger audience of potential investors. And that's it. It's like, it's just another option to stack in there alongside, in your capital raise. We're going to start seeing companies that raise, they might raise $1 million on WeFunder, but maybe they raise $200,000 from retail investors, right? So they raise $800,000 from angel investors and venture capitalists. They're using WeFunder's checkout flow to do that. And the reason they're doing that is basically it's simplifying, it's giving you a single point of truth to point all of these investors. It's giving you a platform to storytell about your company.
Yeah, I mean, that's exactly the scenario we had at Paragon. I mean, if you look at the millions of dollars we've raised from accredited investors to start with, it sort of validated the whole thing. And then you go to the WeFunder platform and go, look, this is what's happened, right? I mean,
what I would say would be nice. I'm sorry.
If you guys started today, sorry.
Well, just real quick, what I'd say would be nice though is if you started with those accredited investors and we were being pointed to the WeFunder environment, and that's where we were learning and reading and kind of going into. Then when you move to the community side, your all accredited investors would have had an experience with WeFunder that could have maybe helped you participate.
No question about it. Yeah, absolutely.
Because this is exactly we just launched that ability in February. So when Paragon was setting up, we could not support that. And we do now. We actually haven't even we haven't even promoted it publicly. We're planning to tell everyone on April 2nd. So you guys are hearing this early that you can now do this on WeFunder. But that's exactly.
We were like the first at bat on Big Talk about small because of freaking media network, bro.
Breaking news here.
Out before April 2nd, though.
Well, what's next Thursday?
I don't know. What is next Thursday? April 3rd or something?
But what were your? We got you. What were your last comments though? Because we got.
I apologize here. What I was saying is basically, like, Eric, you hit the nail on the head there, right? It's like we've had this false separation, and what we want to create is a place where it doesn't matter what regulation you're raising under. It's the people that are passionate about you. When the big checks are going to come in first and validate this, and you're going to help build momentum there. And then you open up, maybe once a year, you open up for the little checks, right? But it's a single place to talk about building your business. And that's the important thing. Is it's not about Reg CF versus Reg D versus venture capital. If you're building a community that's going to back you, it shouldn't matter if you're rich or poor, right? It just matters that you're passionate about the problem. And so if you're storytelling there, that you're creating leverage and creating the potential of investment. That's what we think everyone should be able to do.
Creating the market.
That's it, man. Well, hey, that's a good place to end. Reed, how do people get a hold of WeFunder? I mean, WeFunder.com?
You can go to WeFunder.com/raise and start setting up company. It's self-service. Our team will reach out. But if anybody on this podcast is interested, feel free to email me at Read, READ, at WeFunder.com. I'm happy to chat with anybody and help them understand how to do this well. And yeah, I mean, that's it. We're always here to help.
Well, I can say that Reed's been great to deal with, and he's always very helpful and not condescending and treats everybody well. So,
well, it's been nice that you spent time with us and helped our audience better understand what's going on. Really appreciate that. Great episode.
I appreciate it. Thanks for the time.
Well, until next time,
this has been another episode of
Big
Talk
About
Small
Businesses.com.
Thank you, Reed.
See you, Reed.
Thanks for tuning into this episode of Big Talk About Small Business. If you have any questions or ideas for upcoming shows, be sure to head over to our website, www.bigtalkaboutsmallbusiness.com, and click on the Ask the Host button for the chance to have your questions answered on the show. Stay connected with us on LinkedIn at Big Talk About Small Business. And be sure to head over to our website to read articles, browse episodes, and ask questions about upcoming shows.